All right, guys, time for another update. It's been about a month and a week, I think, a month and a week and a half since I did the last video. The last video I did, I named it A Case for Going All In. Um, and I think I got pretty close. Yeah. So then maybe 2 weeks from the top, that video was. So we did the video back on, I think it was like the 23rd. I had sent out the video, and 2 weeks later the S&P had put in a top-ish and has been going sideways ever since. The Nasdaq, on the other hand, freaking crazy, man. um, Also kind of pulled in what looked like a top at the time, but man, this thing just kept going, mainly carried by the Apples, the Shops, the Amazons, the Coops, the Teams of the world, all hitting all hitting new all-time highs or close to new all-time highs. Just pretty incredible action. I think even PayPal, just an incredible run. Square, I think this one, yep, just an incredible run. We're seeing moves that just kind of incredible, just really incredible moves. Um, but this video, I want to give you guys just a broad update on the market, but then also uh, get a little further into what we had talked about on the last video. One of the things I had brought up on the last video was this chart. And this was the growth to value spread. Okay. Growth to value spread. I'm going to show you a different way of looking at it, and then we're going to take a look again one more time how you guys can take advantage of it. So one of the best ways to do that, IWD, IWF. So what this is, IWD, actually I want to do this the other way around. IWF minus IWD. All we're doing is creating a spread. So the idea behind this is we want to, and we're using the Russell. So 1,000 of the best Russell growth stocks minus, is it growth? Which ones? Let's see here. 1 second. Let me make sure I got them right. All right. So it's 1,000 of the best growth stocks minus 1,000 of the best value stocks. And so you get this chart. What this chart signifies, it's a different way of looking at this one, okay? So back in 2000, 2001, growth was just created a massive spread with value. So what that means is that everybody was piling into growth stocks. And back then it was the dot-com bubble, the tech bubble, computers, yada, yada, yada. That's what caused that that kind of bubble to form. We are in something now. This was back in March. This was probably a few days from the lows in March when this was taken. I don't have an updated one of this because this is the Bloomberg terminal. Bloomberg terminals are a ton of money. But I do have something that's almost as good. And what this is it's the same spread. It's just denominated like this. So back in 2000, this was the spread. Pretty crazy. It got up to 30. Now the spread is at 82, more than a double. What that says is that this spread here, this allocation towards growth that is more than it's ever been in the history of the stock market, has now just blown even higher. And one of the things to consider is that we're still in an election year, and volatile, and it's almost like a perfect storm. Like there is no better scenario for this to happen than during a pandemic in an election year. I would expect that this doesn't just keep going. However, what I would say is that I said that exact same thing back in August, September of 2019. So back in August, September of 2019, we were here, okay, back at 35, which was a similar spread as far as how everybody was allocating their money to 2000. Well, since then, since August, September of 2019, we have more than doubled that spread. And look, this is like an elastic band, okay? The further you spread it out, the further it's going to take to get back to the mean. Like I had said in the last video, in this scenario, you have to look at the market as kind of like a mean reverting mechanism. In that when things get kind of dislocated like this, it's going to end up coming back. If it comes back violently, if it comes back steadily, that is the question. Back in 2000, the difference is that back then there was a lot more there was way more companies that didn't make any money that people were piling into. Now, a lot more companies are making money and they're piling into that growth. There are still some, and we've talked about this in the past, in the software space that is just, makes no money, pays no dividend. Yes, it grows every quarter. Yes, it grows every year, but still just completely overvalued and unprofitable of a company. And sooner or later, that has to correct itself. And one of the things that causes is when you see things like this. So this is the spread, but then if I was to just go take like the 5 most valuable companies in the United States from a value perspective and just look at where they are right now. So look at like Ford, United States Steel, Freeport-McMoRan, JP Morgan. If we look at some infrastructure plays like Summit Materials, if we look at GVA, Granite Construction Engineering, companies that are extremely valuable but are being priced like they're going to be going bankrupt. We can further look into companies, and I had gone through this before with you guys, but if you were to just build out a portfolio right now and you wanted to stay away from overvalued growth names, the best way to do it is just go to FinViz, go to the screener, go look at the description, right? So go to descriptive, price over 3, dividend yield over 5%. Nothing else really matters in that scenario. Industry sector, don't worry about any of that. Then you go to fundamental. You're looking for profitable companies currently and projected out into the future. We want them to be profitable, low debt, and a price to book value under 2. You could get even more. You could do price to book under 1, but price to book under 2 is still, companies that are relatively fairly valued. And what you're going to see here, and I sorted it by dividend, is some of the yields on these stocks, like AllianceBernstein, an asset management company, just a really good company, been in business a very long time, grows a little bit still, great return on investment, great return on equity, and they're just being priced like they don't do anything. And with a 9.6% dividend, obviously, if the price goes up, that dividend yield goes down. But look, even if the price was to correct 50%, you're still going to get 4.5% for a company that does as well as AllianceBernstein does. That's really, really attractive. And look, this company hasn't shot the moon, right? So this is a company that's, was all the way at $92, came all the way down to 10. It's been sitting between, say, 10 and $35 for the last 10 years. Extremely, extremely attractive company. If you were to look at some other companies here, ExxonMobil, we've talked about that. Now, the risk is that oil prices collapse, but as long as demand starts picking back up, I think oil prices stabilize. If oil prices stabilize, then I think these companies in the oil patch become extremely valuable again. We could be seeing something where ExxonMobil stays at, around $40-$50 a share for a while. But even in that scenario, you're grabbing yourself about 7% dividend. Again, that's extremely attractive when it comes to building a foundation of your portfolio. We could go on and on. So Vail, that's natural resources. Janus Henderson, more asset management. A lot of regional banks, Region Financial. I think there's some other ones that don't fall into the category. I think I always mention them too. Huntington Bank Corp, Fifth Third Bank Corp, Webster Bank. The regionals are extremely undervalued too. If I would just go to regions, right? So, financial crisis destroys it, goes from about, say, $38, $39 a share all the way down to $3, bounces back up to 20, settles around 10. The one thing I would say here is that if there's going to be any kind of inflation in the future, any kind of if rates increase over the next, say, 12 to 18 months, that's extremely good for banks. The higher rates go, the better it is for banks because they could create a better spread on the products that they sell. So that's extremely important. That's extremely attractive as far as building foundation of your portfolio. So as far as the market's concerned, look, we're still in an election year, okay? There's going to be more volatility. I think I had said in the last video, and this is mainly regarding the S&P at this point. The NASDAQ already took out the highs, but I do think the high and the low are in for the year. It's looking like the way this is consolidating, we're going to take a shot at the highs, but man, it's tough to see this thing continuing to go. But it could. So, but even still, with increased volatility likely prior to the election, most people are concerned that we're going to test this low. I would always reference these kind of data points. The AAI sentiment survey, nobody is bullish right now, folks. Nobody. The historical average, and they started this back in 1980 something, I think. I always forget the date that they started this, but they started this survey back in like the 1980s. Since 1987. There we go. So the historical average for bulls, which means that they think the market's going to be higher in 6 months, is 38% on the historical average. It's currently at 22%. This is one of the lowest levels I've ever seen in my lifetime since I've been tracking it. I think historically the low that's been put in for bulls is about 18%. So people are very, very bearish right now. So you're about 15, almost 16% above the historical average of bears, meaning that people think we're going to be lower in the next 6 months. From just a sentiment perspective, when you look at these things, you want to look for extremes, and we're currently at an extreme. We're currently seeing people as bearish as they've ever been, as the market has rallied 30-40%, depending on the indices depending on the indice you choose, over the last 3 to 4 months. People have continued to get more and more bearish as the market continues to rise. A lot of people think this is a dead cat bounce. A lot of people think we're going to be testing those lows again. It seems more and more unlikely that that's going to happen as more and more people believe that it will. So just something to consider there, especially when you're looking at it from a sentiment perspective. Another thing, too, is that one of the other portions of the Bank of America Global Fund Manager Survey, they're looking at these are kind of like the most crowded trade. They do this every single month. And currently, the last couple months, they've been thinking long U.S. tech and growth, where prior they were looking at long U.S. treasuries. Okay, so the last it looks pretty much December to now, it's been U.S. Treasuries or tech and growth. Actually, wow, going back even further now that I'm looking here, all the way back to May 2019, it's been long U.S. tech and growth, and treasuries have been the most crowded trade, which is just simply incredible. It really is, because it's a sign that, look, if you're getting into bonds, which is U.S. treasuries, you're playing defensive. But at the same time, because everybody's piling into bonds, that means the yield on those bonds are decreasing. So as the yield decreases, that is a good thing for tech stocks. So it's creating this kind of weird, like, symbiotic relationship in a way, whereas as everybody piles into defense, it's making the yields go lower. And how do U.S. tech companies fuel their growth? They do it with debt. And the lower the yield goes, that means they can do it with cheaper and cheaper debt. So really, really incredible thing that we're seeing over the last, what is it, 14 months now? So over the last 14 months, this has been going on. It's just kind of incredible to see. One of the other things that we've looked at in the past is we've looked at the amount of cash. Okay. So this is the fund managers, how much cash they have, average cash balance for their funds. What you saw at the end of 2019 was that cash was being deployed as we continued to run up. We've talked about this in prior videos, how that's not a good thing, right? That means that, everybody's piling into one side of the boat's going to tip over, and that's kind of what happened. It's funny that happened at the same time that COVID hit, but those are some of the quote unquote coincidences of the market. But everybody in March and April started piling back into cash. And now, come June, July, they're looking to start redeploying that cash. Now, obviously, that makes sense, right? The market's been ripping. The reason why I don't think we're going to get back to all-time highs in the S&P, but hey, who knows, we could, is that if they're going to keep deploying cash, we're going to get to a point like we did back in 2019, where all that cash is deployed again back to the 3.5%, 4% level. If we do that, that's the volatility that I am expecting. We're going to be getting more and more volatility as they continue to try to get in and out of this market. And we looked at in the prior video, I believe hedge funds were net short against the market. So if every single hedge fund out there is betting that the market's going to go lower, well, that gives a lot of fuel for the market to go higher. There's a lot of those types of kind of inverse kind of thinking when it comes to this stuff. And just keep in mind that there's about 50 variables that you have to juggle here to get a good picture of what's going to happen next. But it's coming to a point where I think, like, hey, like, everybody got out at once, everybody started jumping back in, and now it's going to be a matter of shaking all the new players out, continuing in this range between, say, 2,400 and 3,200 for a little while, quiet down the market into the end of 2020 and into 2021, and then race to new all-time highs again in the S&P. That's what I think is going to happen. I've been saying that hopefully we get a summer of going sideways, but man, it doesn't seem like that's going to happen quite yet. So, but we'll see. So again, we saw it in the last one, but cash, fund managers are positioning to cash again, overweight cash, overweight bonds, overweight U.S. Companies. They are underweight like never before. Energy, materials, equities, the value versus growth. I find it interesting they added the value versus growth into positioning. That's very interesting. It means that they're actually kind of starting to look at value versus growth, whereas before you would normally not see value versus growth as a listing. So that's something to really think about as well. We don't need to talk about that one. It's kind of the same data points. So one thing, listen, if you have family and friends talking about companies like Shop, if they're talking about companies like Zoom, if they're talking about companies like Team or Coop, okay, or I think even Zillow. Well, no, Zillow's fine. Wayfair? Yeah, Wayfair. So if you have family and friends talking about those types of stocks, saying, "Hey, we should get in," it just keeps going higher. Tell them to not do anything stupid. Okay? At this point, they're no longer investable. They're trading vehicles at this point. You want to bump in and out of these things, go right ahead. There's plenty of volatility to make money both ways. But you want no part of putting Wayfair in your portfolio at $214 a share. Um, you don't want to wake up one morning and be down 20 or 30% in a day. And believe me when I say this, with the way this thing has gone up, it is going to be down 20 to 30% one day. It's only a matter of time. Wayfair is a absolutely, in my opinion, quasi garbage company. It's a retail company. It was trendy. It is trendy for a while. And I think sooner or later that bubble will burst in what it is selling. Um, so that's it for this video. A little all over the place, but it's been like a month plus. So I figured, even though not a lot has happened, kind of some of the same things we talked about in the last video continue to get out of hand, like the growth to value trade. Um, but I think it's just kind of a good idea to continue to look at some of these dislocations in the market, look at some of the opportunities like the regional banks, like materials, like industrials, like energy, and keep give you a heads up on what's going on out there. So hope you guys enjoyed the video. If you have any questions, just hit me up via email, and I'd be more than happy to answer them. If you guys want any help putting together a portfolio or anything like that, just let me know. I got some Excel tools. I got some Morningstar that can really help with that. For friends, I do that on the bubble. So yeah. All right, guys. Have a good one. Enjoy the 4th. Take care.